Well, so now I have 10 people, right? So let me share my screen. All right, there we go now. And before I bring up today's slide, let me go check. There are 10, right? 10. Yeah, exactly. The number matches, right? The number between the people in the collaborate and the. So in our last class, we discussed, the difference between the lending rate and borrowing rate, and the difference between nominal interest rate and real interest rate, right? Remember that? And there's further classification of interest rate, which is simple interest rate versus compound interest rate. Now, you already know what compounding is because we talked about compounding already, while we were talking about geometric average, right? So, and then compound. Then what is simple interest rate? Well, unlike compound interest rate, which is like snowballing effect, simple interest rate is not. Simple interest rate is simply how should I say? Every year, your interest is not compounded, but your interest is just earned based on the principal. So mathematically, we already understand what compounding is, but let me put it this way. Let me use the I can push it up any further. So we know compounding. We know compounding is basically future value at time n, right, is principal times 1 plus r, right, the rate of return raised to n. That's compounding. So for example, if you have...
Can you repeat that again, Professor?
Yeah. Future value at time n is principal times 1 plus r raised to n, raised to the nth power, right? So for example, future value at the end of year 2, if your principal was 10K, if your principal was 10K, and then if interest rate was 10%, it's times 1.1. It's so hard to... 1.1, that's 10% interest rate. And raised to the second power, or squared, right? And then, this is going to be, if you just do the, use the calculator, it's going to be 12.1K. Okay, $12,100. On the other hand, let's just verify that using the calculator. 10,000 times 1.1 raised to, here you have x raised to y, and then the symbol there is, caret, right? Raised to 2, right? 12,100, right? And just like that, FV3, if you want FV3, under the same scenario, right? Future value at the end of year 3 then is 10K times, right? That's times 1.1 raised to the third power, or cubed, or raised to the third power. And then it's going to be registered. 10,000 times 1.1 raised to the third power becomes 13,310. So it's going to be 13.31K. Right? But under simple interest, if we use simple interest rate, simple interest is, in simple interest, it's not compounded. Interest is not compounded. So the formula for simple, it's obviously easier. It should be easier, right? Future value n is simply P times 1 plus 1 plus r times n, right? Not raised to n. So, and then it's going to be a lot easier because then by simple interest rate, future value in year 2 will be 10K. 10K times 1 plus, right? And 0.1 times 2, right? So 0.1 times 2 is 0.2. So I'm not gonna. I'm just gonna put it like 1.2. But then what's it gonna be? It's simply 12K. And FV3, if it's gonna be FV3, future value at year 3 is gonna be, simply 10K. It's a lot easier. Times is simply 13K. So obviously, between the if you are an investor, right? If you are an investor or saver, right? Between the compound interest and simple interest, which one would you prefer? If you're the investor, which one would you prefer?
Compound interest.
Nobody?
Can you hear me, Professor?
Nobody gets that?
What was the question again? I'm sorry.
Pay attention. If you're an investor, between the compound interest rate and simple interest rate, which one would you prefer?
The compound?
Yes, of course. Yes, of course. It's a common sense question. If you're an investor, you would prefer compound interest rate. Isn't it right? Because who would prefer to have 13K over 13.31K? Who would prefer to have 12K over 12.1K? Goes without saying, if you're an investor, you want the compound interest rate. Okay? And who said that? Who gave me that answer?
Stacy.
Stacy.
Yes.
Okay, Stacy, I'll give you 0.25 for that. Yeah, so the answer is obvious, compound interest rate is preferred. And actually, Peter, your microphone isn't working. Yeah, please check your microphone setting because, I don't know. Down here, you can see that that's the taskbar, and in the taskbar, you will be able to see the microphone mic icon, or otherwise you can pull up the what's it called, menu box, or otherwise you can get to that through your control console. So check your microphone setting. So the answer is already obvious, but then obviously a simple interest rate will fall out of favor, right? Nobody will use simple interest rate. It's actually no, people still they use simple interest rate, but then the market is different, right? The market is different. Simple for long-term financial market, and long-term financial market is also called long-term financial market uses in the long-term financial market they use compound interest rate. Okay, but for short-term financial market they use simple interest rate. So what does that mean? Long-term financial market is also called capital market, and long-term means any time frame greater than 1 year, any time frame longer than 1 year. So if you're investing for if your holding period is greater than 1 year, it's always compounded. Your interest is compounded, right? Whereas in the short-term financial market is also called money market. Money market and short-term then means under 1 year. Short-term means the maturity under 1 year. Okay. And if the maturity is under 1 year, then how would you compound that? Oh, you can't compound it. I mean, technically, mathematically, you can, but generally people don't use it. Generally, they don't use it in the short term because compounding is used for like at least annual time frame, and if the maturity is less than 1 year, that means like 60 days, 30 days, 90 days, 45 days, right? 120 days. That usually theoretically, the maximum maturity in the money market can be up to 359 days. 359 days. But or 364 days. But look, nobody lends money for, or nobody, I mean, think about it. If you're lending money for 349 days, I mean, what's the point there? I mean, 359 days. What's the point? I mean, why wouldn't you lend it or borrow it for the whole year? Make sense? So usually usually the maturity is really short term, like 30 days, 45 days, 60 days, and theoretically, theoretically up to 270 days, which is 3/4 of a year. But that type of instrument, that type of debt instrument, is hardly held. It's hardly circulated. Usually, the maximum time maturity is like 60 days. Then, under such circumstances, under such scenario, how do you apply the simple interest rate? Of course, then the simple interest rate is simply what is that? What's that? Oh yeah. No. It's about I started a computer because this.
Can you now?
Yeah, I can hear you now. I can hear
It
you.
was crazy.
Okay. I never used Mac. I personally, I'm an Apple owner. I have, I don't know how many shares, but I have decent number of shares in Apple. As a company, I like Apple, but I don't like Apple product. That's contradictory.
It's madness.
I don't find it any look in the past they used to say Apple is more intuitive. Why? Because they have user friendly GUI, graphic user interface. That was in the days of Macintosh, 1982. Yeah, if you were in 1982 or 1986, 1989, you could say Apple is better because it's more intuitive. But since the Windows 95, there's no difference. Since 1995, all IBM PCs, basically they all have I don't know. For me, Apple is less intuitive than IBM. Anyway, so if your computer is just my IBM, then it would look like this. You would have taskbar and Anyway, the point is, where was I? Yeah, because the simple interest rate is used in a short-term financial market. They use it actually to, for example, it will look like this. What's going to be the future value in 60 days? Let's make it 60 days, right? So you got to make it clear that it is days, Then, and if under the same scenario, all you need to do is 10K times 1 plus 10%, right? But then 10% must be, because 10% is for the whole year, you must adjust it by 60 over 360. Okay? You must adjust it like that. That's, that's quite a, common sense, it stands to reason, you have to make that adjustment. Then you might wonder, Why? Isn't it 365? 1 year isn't 365. That's called exact interest year. And in the financial market, there are two types of years. One is ordinary interest year, ordinary. An ordinary interest year is 360, and the exact interest year is 365. Okay, so this is how simple interest rate works, actually. Okay, all right. So
You said ordinary interest year was what number again, Professor?
360. Okay, ordinary interest year is 360. Exact interest year is 365. Okay, and ordinary is the default. Think about it. Why is it called ordinary? Because that's the most commonly used year, right? And that's for calculation, simple interest calculation. Okay, unless otherwise indicated, right? The default is ordinary interest year. Okay, so anyway, we're gonna come back to compounding later. But now we all understand, basically why there is, why, what are the classifications of interest rates, and then we also understand that the benchmark for interest rate is Fed funds rate, right? I believe we talked about this last time, how the Fed funds rate. So benchmark interest rate is, Fed funds rate. And then and as we discussed, how the interest rate, why interest rate went up in the early 2000s. Actually, interest rates were Fed funds rate was about 1.25, right? In early 2000s, right? So that was, and early 2000s, you were probably generally born. Most of you were born in early like 2000, 2001. 2002. If your parents bought a house, most likely, and if you were born around that time, your parents must have bought a house around that time. Why? Because the mortgage was very good. Housing market was booming in the early 2000s. Why? Because the interest rates were very low, like 1.2. But since like 2005, around 2000, the graph isn't showing 2005, but from 2005, interest rate went up almost by 4%, because it was like 1.25, but over just 1 year, it went up to 5.25. So almost a 4% increase. That's a drastic increase. That's a crazy, increase, over just 1 year period. Because when the Federal Reserve changes the interest rate, they do it gradually by a quarter percentage point, and they do it gradually, quarterly. So if they raise interest rate, they do it like by a quarter percentage point every quarterly, quarter by quarter. So if interest rate goes up normally by 1%, it would take 1 year, right? At least 1 year for interest rate to go up by 1%. But between 2005 and 2006, it went up by 4%. Over just 1 year. It's like 1 percentage point every quarter. Of course, it's a long story, why they had, why the Federal Reserve, had to do that. It was banned. The Federal Reserve chair was Ben Bernanke at the time, and after he served 2 terms, and then Then after Bernanke, it was Janet Yellen, who served only one term, and now it's Jerome Powell. Most likely he's going to serve his second term, and he's in his first term now. But because of the housing market boom, right, early 2000, and it eventually ended up in subprime mortgage crisis, and which which was the onset of the financial market crash in 2008. But the subprime mortgage crisis broke out in September 2007. I remember clearly, September 2007. And it was all because and they talk about collateralized, debt instrument, or CDI, or collateralized, mortgage debt, debt, whatever they call it. And so it wasn't only the interest rate; it was also the collateralized, But the collateralized, debt instrument. Collateralized debt instrument was only possible because the mortgage interest rate was so low, and because they were another factor was they lifted, or they abolished Glass-Steagall Act, which separated investment banking from commercial banking. And they were actually, everything, so those factors, at least three factors, played part. And they were even lending out. Now, why is it called first subprime mortgage crisis? Because they lended out to people who didn't even qualify for any mortgage, right? And then, of course, and they were, they loaned out to the people. Now, they could buy a house. The people who didn't qualify, first of all, their credit score is, derogatory. Two, they don't have any income. I mean, no decent income. I mean, to be able to pay the mortgage, you have to have decent income. They didn't have decent income. They don't, and that's another reason they had very bad credit score. But didn't matter. The banks were on an all-out war they were competing with each other to lend, because that's that for the banking industry. Think about it. How many loans they have outstanding means how much funds they were able to channel through the market, right? So that's like a indicator of their market dominance, right? It's like an indicator of their market dominance, market share, market dominance. So they were in an all-out war. I don't know if you are, somebody is, here, let me see. Okay, so it's like I guess you are all. The chat was not about the this topic.
It is. We were just trying to make a group chat about the class.
Yeah, but not about this topic. It was about your chat, Google, whatever, WhatsApp group or something. But not directly about 2007 subprime mortgage crisis, or 2008 financial crisis. So, But then you would wonder, why would they, why did they raise the interest rates so drastically over just 1 year? Because Ban Bernanke uh, uh, feared that he would have, because of this there was so much in the financial market, because interest rate was low. Not only there was a lot of lending, but also, when interest rates are low, it's easy to borrow money, right? We all understand that it's easy to borrow money and then they borrowed money and put it into the stock market. Okay, and that's usually what happens. But actually, in early 2000s, the stock market was actually stuck. Stock market wasn't growing that fast. Rather, all the money was, funneled into the housing market, right? But basically, it's money supply. Money supply was, abundant in the market, and since because of the abundant money supply in the market, Ban Bernanke was worried that this would uh, uh, bring about high inflation. So that inflation scale was so dominant, it was so rampant in 2006, 2005, 2006, and Ban Bernanke didn't want to become the Fed chairman in the history with the stigma of the one who couldn't prevent the inflation. So then he hiked up the interest rate. And then what happened? Then 2007, a subprime mortgage crisis, and then subprime mortgage crisis brought about the collapse of, CDI, collateralized debt instrument, and then Bear Stearns had a huge holdings of collateralized, debt instrument. So Bear Stearns, was in trouble, and there was no, and then Bear Stearns, eventually went bankrupt, and that, you know, spread out throughout the entire financial market. So the financial crisis. So then, they dropped the interest rate. Now this happened over just 1 year period. Look, from 5.25 to 0.25, 5% drop over just 1 year. And why? We all understand. Interest rate. We all understand, if interest rate is high, if interest rate goes up, it discourages borrowing, because it becomes, more difficult to pay back, right? High interest rate is always the burden on the borrower, so borrowing goes down. As the borrowing goes down, so it's the businesses, mostly businesses borrowing, right? When businesses won't borrow, the borrowing goes down when interest rate is high, because it's burdensome, and also the economy was just going into recession. During the recession, who is expending? During the recession, who expends? Because you will expend only when the economic outlook is very positive. Isn't that right? You will expend, right? Because if you expend, but the demand is, very slow, very slow, then your expended, production capacity will be just idling, right? It will just turn into an excess capacity, because with, increased production capacity, all the goods that you have produced will not sell. A lot of it won't sell, and then you will, because you cannot recover your cost, you will be in loss, right? So nobody's going to expand during the recession. So anyway, So there's no borrowing. As the borrowing goes down, money supply throughout the economy goes down, right? Money supply throughout the economy. So because nobody's expanding, so nobody's hiring new workers. No, even the old workers are downsized. Even the old workers are laid off, right? And since you are not expanding, you're not hiring any construction company to build new plant. Since you're not building new plant, you're not buying any new production equipment. So the production equipment manufacturers, their businesses, declining. Construction companies, businesses declining. Sales are declining. So they will have to lay off workers, and you will have to lay off workers. So there is a negative feedback effect. There is a negative feedback into the economy, right? And that's the result of decreased money supply. And as the money supply goes down, I told you why. Y stands for the output of the economy, output or income of the economy, right? Output and income are basically the same thing. Income is nothing but output distributed back to the economy, right? Income is, dollar value of all the output, right? When the output is redistributed across the back to, the economy, across the entire economy, that's the income, basically.
Are we talking
And then
about
the mirror image.
are we talking about the money flow? Like, what are we talking about right now?
Money supply, yeah. Look,
Money supply, right?
yeah. This means money supply.
Okay, so we're talking about the MS in money supply. If interest is going up, what the lender is borrowing.
If the interest is going up, that leads to decreased borrowing. Borrowing goes down.
And the lender in
Right?
that situation will be the federal bank. That's FRB.
No. Any bank,
Okay, this is overall
any
any
lender.
bank. Okay.
Hmm?
You're saying this is overall in any banking situation, overall any lender.
Any lender will. It's not because the lender is reducing lending. Borrowers, from the borrower's perspective, look. But I've been telling you, businesses will reduce their borrowing. Do you understand?
So, somewhat, I'm following you. Somewhat. I'm not gonna lie, like I can understand it all right away, but you're saying overall businesses when they take from
Yeah.
the
Look,
bank.
in general, borrowing will have to go down because if interest rate goes up, it's not somehow. So it's not somewhat. It's an indisputable fact because if interest rate goes up, it becomes more burdensome, right? You won't increase borrowing when interest rates are higher. You understand? If you
I'm
if you
writing it
have
down
to borrow,
as you're speaking, by the way, too. So that's kind of
what?
why I'm writing it down as you're speaking.
Yeah. Look, if you have to borrow, you will still have to borrow, right? Regardless of where the interest rate is. But if interest rate goes up, anybody, whether you're a billionaire or whether you're a pauper or billionaire, it affects everyone in the same direction. It's more burdensome to borrow, isn't it right? It's just logical. If whether no matter whether you're a billionaire or a pauper, still the same thing. If interest rate is used to be 5%, but now interest rate is 10%, it's more burdensome, no matter who you are, right? To pay back, it's more burdensome. So businesses will. So overall tendency is that the borrowing will go down, right? It's not because the lenders are. It's not because the lenders are reducing. It's not because the lenders are not lending. It's because the borrowers are not borrowing. You understand? I wrote borrowing goes down, not lending goes down.
Yeah, because it costs too much.
You made
Of
a
course,
video,
it costs too much,
Professor.
right?
You made a video explaining all of this, right? Going over all of this.
Yeah, the main lecture video already explained all of this,
All right.
right? As I said, collaborate session is not the main lecture. Main lecture is already, delivered through the main lecture videos. So the point is, businesses reduce borrowing, and of course, um, and also I told you, and after, during the financial crisis, it was recession, right? Recession lasted uh, officially. Officially, recession bottomed out in like 2010, if I remember correctly, sometime in 2010. But bottoming out doesn't mean that the economy has, recovered right away. Recovery took a long, long time. Recovery took almost like, a decade. It just means it bottomed out in 2010, right? Bottomed out. But think about it. During the recession, uh, not only because the interest rate is high, but during the recession, they don't borrow, they don't expand because economic outlook is not positive, right? Because during the recession, a lot of people lost jobs, spending goes down. So obviously, it doesn't make sense to expand your production capacity during a recession because what you produce won't sell, and you will only be stuck with unsold goods, which is, that means you can't recover the cost of production, right? You can't even recover the cost of production, and then you are, stuck with that loss. So nobody would want to do that, right? So businesses don't borrow, so borrowing goes down, and that will lead to decreased money supply because as nobody is spending. First of all, businesses are not expanding, so they are not. Think about it. I explain. I'm duplicating this all the time because if you just pay attention, it's logical. Because companies are not expanding, they are not hiring any construction company to build their plant. Since they are not doing that, they are not even hiring any. They are not buying production equipment. So companies that make production equipments are not getting any jobs. They are not getting any orders. So they are also, they will. Their sales revenue goes down. So they cannot pay their workers. Construction company cannot pay their workers. They will downsize. They will lay off their workers, and you will lay off your workers too because it's a recession. Your goods are not selling. Your production, you have over capacity in production. You have to cut down on costs. So what do? You lay off workers. So decreased. So workers don't get paid. They lost their jobs. They don't get paid. So spending goes down, right? So decrease in money supply. Decrease in money supply is caused by decreased borrowing, and money supply throughout the economy is decreased because the workers lost their jobs. They can't spend money. They can't spend uh, companies cannot spend money on expansion. So this is overall decrease in money supply. And decrease in money supply will cause the output of the economy to go down, because as spending shrank, obviously supply one nobody will produce at a nobody will produce more than the demand, and the demand is down. Supply will also go down, right? So overall size of the economy, the output economy shrinks. That means the size of the economy shrinks. Out and the because the output decreased and the size of the economy decreased, the dollar value of that income. If the economy shrinks, the income shrinks too, because that's income is the dollar value of the output. Okay, and it's exactly the mirror image of that. It's the mirror image. When interest rate goes down, borrowing goes up, right? It's less costly and it's less burdensome to borrow, and that's so the companies expand their production capacity, and as they expand their production capacity, they will have to hire construction companies to build new plants, and they have to put in the production equipment to these new plants, hire more workers. Construction company gets the project, so they hire workers, they pay their workers, and then the company that makes production equipment, they also hire more workers, more raw materials. So the more workers get paid, raw material suppliers get paid. So there is, they spend money, workers spend money, workers who got paid spend money. So money supply throughout the economy increases. Okay. So overall economy expands. Overall economy grows. So you see the connection between interest rate and the economy, and then you may have noticed that this relationship is inverse. There is an inverse relationship between the interest rate and the economy, right? So that is why the Federal Reserve lowered the interest rate here back in 2009, January of 2009. They lowered the interest rate, the benchmark interest rate, and the benchmark interest rate in the U.S. is the Fed funds rate, Federal Funds Market Rate. It's the short for Federal Funds Market interest rate. So look, Fed funds market sounds like, but this is something you have to clearly understand. Federal funds market is not Federal Reserve, okay? And Federal Reserve is not the government, okay? Federal Reserve is not the government agency, okay? Federal Reserve. Most other countries, central banks are. I'll have to check on this if countries, I believe even in other countries, the central banks are not necessarily the government agency, but always the chair of the central bank, or the governor of the central bank, is appointed by the president, but the central banks are not of any industrialized world. democratic capitalist, economy, in any capitalist, democratic capitalist system, central bank, head of the central bank, and central bank is not the government agency. But the Fed funds rate, once again, Fed funds rate is not, Fed funds market is not Federal Reserve. The Fed funds market is actually the market for borrowing and lending between the commercial banks. Okay, so it's like an online marketplace like eBay, right? It's like an online marketplace like eBay where commercial banks borrow from and lend to each other. Okay, in case they need. So please, remember this very, clearly, that it's not just because the name is, Fed funds rate, federal funds market rate. You think it is, some federal agency? No, not at all. It's totally private, right? Marketplace for commercial banks. The only reason the name is, just because, federal, because they are lending and borrowing across the, state borders, right? It's just called federal funds market because, and in the federal funds market, then, you also mistakenly tend to think that because Federal Reserve sets the Fed funds rate, then isn't it, under the control of the Federal Reserve? Actually, no. Federal Reserve doesn't own Fed funds market, but how do they set the federal funds rate? Well, actually, they don't set the Fed funds actual Fed funds rate. They just try to they set the target rate only. Target rate. Anybody can have a target for federal funds. I can have a target for gas price. Which means, I cannot influence the gas price. But what I'm saying is, the gas is too expensive now. But if the gas price goes down to below $3, then that's the time I'm gonna fill gas in my car. That's your target, isn't it right? Whether you actually influence the gas price or not, it's irrelevant. You can have a target for yourself. Well, it's just like that. But for Federal Reserve, they can actually influence it. They can set the target for Fed funds rate, and they can influence it. How? Not by order, because this is not. We are not living under a dictatorship. Federal Reserve Chairman Jerome Powell is not a dictator. So it's not like let the rate be 10% from tomorrow. No, it's not like that. They're not issuing an edict, right? They're not issuing a decree. But what they do is they participate in the bond market. They participate in the bond market, and through buy and sell, right? Through the bond market transaction, they try to bring. And I said bond market, but in general, lending, credit market, they go into the credit market, and through the operation, market operation, in other words, buy and sell, they try to bring the actual market rate close to the target rate. Okay, so all these are literally target rates. So target rate means, you know, everything is like from January 2009 through December 2015. It was 0.25%. Now, look, what that means, you know, if the target is 0.25, that means range. The actual Fed funds rate was somewhere between 0 and 0.25, right? You cannot exactly hit the target. I mean, the target is, you know, set by the Federal Reserve, but the actual market rate could oscillate around the target rate, because it is every day, it changes every day, you know, due to market transactions. Okay, so here's a very important concept. Why does the Federal Reserve? It's obvious. The Federal Reserve is the central bank, so the central bank will. Central bank has the dual mission. Dual mission is, it's always, you know, reiterated whenever, you know, Jerome Powell, the Federal Reserve chair, holds press conference, is saying that Federal Reserve is, you know, on a mission to achieve the dual mandate. Mandate is what bring the price to basically bring the inflation to a manageable range. You know, it's not zero inflation, right? They never say zero inflation. Bring the inflation to bring the price level to the appropriate level, appropriate range, which is, you know, 2%. You know, Federal Reserve's, you know, target inflation is 2%. It has been, right? All these years, it has been about 2%. Why isn't it 0%? Look, why? Think about it. Zero inflation is not necessarily a good thing. I'm gonna talk about that later. Dual man. I'm talking about the dual. And then first one is, so bring the price level to the desirable optimal level, and then sustain, keep the economy, stay on a sustainable, sustained growth path. The economy should, you know, look, yeah, the role of the central bank is quite important to the economy, because central bank can, you know, through the monetary policy, they can stimulate the economy if the economy is in recession, and cool off the economy if the economy is overheated. So that's what, you know, that's the dual, what they call the dual mandate of the Federal Reserve. And the role of the Federal Reserve is, because it's a central bank, so it's an ultimate authority in the monetary policy. So they set the target rate for Fed funds rate, and the actual Fed funds rate is determined by the supply and demand for funds in the Fed funds market. Second, it's a regulatory authority in commercial banking, of course, because Federal Reserve is the central bank. So it's a regulatory authority in commercial. Commercial banking is retail banking. Basically, you put your money in the bank and borrow money from the bank. You get a home mortgage loan, car loan. That's all commercial banking. There are two types of banking: commercial banking and investment banking. And commercial banking and investment banking were separated. And this was the result of Glass-Steagall Act after the stock market crash of 1929. Glass-Steagall Act, separated commercial banking from investment banking from commercial banking. But back in like 1998, that was during the Clinton era, Clinton presidency, almost at the end of Clinton presidency. They repealed Glass-Steagall Act. So then, there was no distinction between commercial banking and investment banking anymore, which then, brought, which had actually a negative side effect. Actually, financial crisis that unbridled lending, subprime mortgage lending was the result of the, what should I say, desegregate? No, lifting the separation is the result of the lifting of the separation between commercial banking and investment banking. So now, after the financial crisis of 2008, then I believe they reinstituted Glass-Steagall Act because the financial industry was taking on too much. They were just taking on too much risk. They were reckless, almost reckless. Now. And the lender of the last resort, right? Because it's a central bank, it's the lender of the last resort. Meaning, when commercial banks cannot borrow from each other, they will go to the Federal Reserve as the last resort. But actually, it's done. Actually, they're not directly borrowing from the Federal Reserve. They actually, sell their bond holdings, asset holdings to the Federal Reserve. So it's not like going to the Federal Reserve and just borrow cash. No. They sell their asset holdings, right, to the Federal Reserve, and then they get the cash from it's called repurchase operation. Repo, meaning they sell their. So if commercial banks are in need of liquidity. That means commercial banks are in short, falling short of cash flow, but they have, so they don't. They are short. They fell short of cash, but they cannot borrow anymore from overnight Fed funds market. Then, but they are holding bonds. Long-term bonds, they're holding stocks, they're holding mostly bonds, bonds of, and commercial papers, and the bonds of the companies, right? That bonds are basically the debt. So if the commercial banks are holding a lot of bonds of companies, that means they loaned money. They loaned money to the companies. But these, and you might wonder, if they are holding bonds of these companies and if they are falling short of cash, then why don't they sell those bonds? Why don't they sell those bonds in the market? They can do that, but they don't want to sell it because if these bonds are paying good interest, right? let's say average interest rate in the market is 5%, but these bonds are paying like 10% interest. They don't want to get rid of these bonds. They want to keep holding on to these bonds. But if they sell it in the market, then they're not going to get 10% interest rate anymore. So what do? They take it to the Federal Reserve. They sell it to the Federal Reserve. Then you might wonder, if they sell it to the Federal Reserve, isn't that the same thing anyway? They're not going to get the 10%, 15% interest anymore. No. This is called repurchase agreement or repo operation. What that means is when commercial banks are short of cash, but the banks are where the money is, basically flowing in and out. So actually, they cannot fall short of cash. But what happens is they can just temporarily, just for overnight. I mean, tomorrow when the bank opens, then the deposit will come in. So their cash flow shortage is not a problem tomorrow, but they need this. Let's say they need $10 million just overnight, and they don't have $10 million. So what do? They don't want to sell these bonds. I mean, if they sell these bonds, then they can get $10 million. What they can do is they sell it to the Federal Reserve on repo agreement. Repo agreement is let me sell these bonds for $10 million to you, huh?
Is that similar to like a collateralized loan?
No, not exactly. In case of collateralized loan, they will, if you default, they can repossess the collateral, right? But first of all, bonds are not backed by any collateral. Bonds don't have any collateral. It's purely based on the company's credit rating. And then when commercial banks sell these, to Federal Reserve, it's just to borrow. In a way, I see what you mean. I see what you're saying now. Yeah, it's like they put this up as collateral. They put this up as collateral. So they borrow money for $10 million, but they do it just for overnight. And the Federal Reserve charges interest for overnight, and then the next day, with the promise that they will repurchase, they will buy it back. Okay, you understand? So Federal Reserve just holds this, asset overnight, and then it's not cash. They don't transfer cash. It's just all balance sheet operation. They just increase the balance sheet, credit balance on this commercial bank. Between Federal Reserve and all the banks, they have credit and debit accounts with each other. So Federal Reserve simply increases the credit to the commercial bank by 10 million, and then that means they can write checks up to 10 million, right? That gives them leeway for cash flow. So overnight they can let's say overnight they found some good investment opportunity in let's say East Asia. Let's say in South Korea they want to invest 10 million in some new stocks in South Korea, and then overnight they were lacking 10 million, so they sell this bonds for $10 million to Federal Reserve just overnight, and repurchase the next day, right? Buy back the next day, and Federal Reserve just increases the credit to this commercial bank for 10 million, and then they can increase their liquidity by 10 million, using that to buy the stocks in South Korea, for 10 million. Okay, so this is basically what is called repurchase agreement, repo operation, and Federal Reserve is a lender of last resort because of this repo operation. Okay, so we are. So the whole thing is, and I want you to, if you you see, I believe you can see, my microphone volume. My microphone volume is 50. But I barely hear you. So sometimes I raise it to 75. But I think you should also. That's my speaker volume. So I think you need to also raise your microphone volume to something like 50 or above, because So it's like this. I also need to talk about how the Fed funds rate and actual lending rate. What are the connection between the two? I must also talk about that, but we're already out of time. But I want you to remember this. The transactions between the Federal Reserve and the commercial banks, those transactions are called balance sheet transaction. Balance sheet. In other words, they simply adjust the balance sheet, right? There's no actual transfer of cash. They simply adjust the balance sheet, and that creates the money supply. How? It's just like this. It's already 3:17, but let me put it this way. Suppose you get a $10,000 loan from the bank. Okay, please raise your microphone volume, right, before speaking to me. Suppose you got a $10,000 loan from a bank. How do you receive it? How do you receive it? Anybody?
They give you a cashier's check.
That's just one way. Okay, and who gave me that answer?
Peter.
Peter. Okay, Peter. Okay, Peter, you got 0.25 for that. Yeah.
Would it be a deposit in your account?
Say that again. Who was that?
It's Eva. I said it would be a deposit in your account.
Yes. Eva, you got 0.25. Yeah, look, in the old days, they give you a check, right? If you got a $10,000 loan, in the old days, they give you a check. These days, everything is digital. They give you a direct deposit. But what is direct deposit? Does that mean cash? Does direct deposit mean cash? Do you see? I mean,
no, it's the money going into your account.
Yeah. But is that? I mean, do you see actual cash? Do you see actual cash in your account?
It's actually just going to your.
It's all numbers, isn't it right? It's all digital. I mean, so. They don't have to transfer any cash into your account. All they do is simply add your balance in your account by 10,000. You understand? So it's all digital, and even if there is no actual cash transferred into your account, and look, when you have your money in the bank, your account is only digital allocation. It doesn't. The money is actually in the central vault. All the money is in the central vault of the headquarter, isn't it right? Of course, the branches also have some money, some cash reserve in their vault, because they have to, they have to put money into ATM, and when people come in to withdraw money, or in cash the check, they have to have cash. But you don't know where your money is when you put $10,000. It's not any your retail your bank branch. It's not in the bank branch. It's everything. all goes into the central headquarter, right? So when you have, let's say your balance is, currently $50,000. Your balance is currently let's say your balance is currently $10,000. You got a 10, and that 10,000 is only digital numbers, digital numbers on your mobile app. And then when you get a loan, another $10,000 loan, then all you see is just just number. Your balance is now 20,000, and although you don't actually have, hold on, although you don't actually have any cash in your account, right? Physical cash in your account, that gives you a power to write check up to 10,000. Isn't that right? Even without any cash, physical cash in your account, you can write a check. So it's just the same thing between the commercial bank and the Federal Reserve. They only adjust the credit account, credit and debit in their balance sheet, right? Between Federal Reserve and the it's not credit and debit on the balance sheet. On the balance sheet, it's like asset side, and liability side. Okay, Federal Reserve will increase the liability side to these commercial bank by 10 million, and then the commercial bank's balance sheet, the asset side of the commercial bank's balance sheet will increase by 10 million, and that gives the power to the commercial bank to make a additional loan, or use that, up to, use the money up to 10 million. Yes. Who had a question? Someone had a question, right?
Yes, I was actually trying to figure out when you were trying to relate that to the balance sheet with the Federal Reserve and the banking industry. When you were saying the 5,000, how they just add the zero. So I was trying to ask you, does that still go on today, where they just add a zero to the number? Because even when they print up money and they change a zero around, isn't it still in circulation?
Yes. They don't look. Federal Reserve doesn't need to print money. It's just a metaphor. It's a metaphor. They don't actually have to print money. I mean, of course, eventually, if the fiat, the money, physical fiat money, if money gets, of course, money gets destroyed, because it's worn and torn, and there should be certain amount of, physical money in circulation. But when they increase money supply, that doesn't mean actually printing money. You don't have to print money. It's just digital, right? They increase the liability side of the through the balance sheet operation. They increase the balance sheet. They increase the liability side of the balance sheet of the commercial bank, and it will increase the ability or the limit of the commercial bank to make loans. And by doing that, the commercial bank increase their loans, and commercial bank doesn't have to actually transfer money into the borrower's account. All they do is simply increase the number, right? It's all digital. It's if you get $10,000 loan, you just get another 10,000. Your balance increased by 10,000. That way, you write checks. You can write checks, and you can withdraw up to 10,000 from the ATM. Make sense? Does that make sense?
Yes.
All righty. So we're already out of time. Like we are like 10 minutes. 10 minutes. Past the. So you guys owe me 10 minutes next time. All righty. So that's it for today. I'm gonna have to. Remind you that this Thursday again, we don't have class because it's Yom Kippur, right? So I will see you guys. It will have to be next Tuesday. Okay. All righty.
All right. See you, Professor.
All right,
Bye,
take care, everyone. Take care, everyone. I'll see you next Tuesday. Okay.
Oh shit.
All righty. All right.
Do we have any homework?
Huh?
I said, do we have any homework for this week?
No, 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 no. You don't have any homework for this week. I
All
mean,
right.
your homework is basically, you're studying the lecture. Studying the
Lecture.
lecture,
All right.
right?